Hello, welcome back again to the channel. In today's video, I'll be taking you guys through on how to calculate goodwill. When you hear the word goodwill, what comes to mind? So let's get understanding of what goodwill is. Goodwill is the difference between the consideration offered during acquisition and what the company actually worth. During acquisition of a company, there must be something that motivates you to go for that acquisition. Probably because the business is doing well, you have seen potential for the future, and then you deem it fit to acquire the company. So the difference between what you paid as consideration to acquire the company and what the company is actually worth is called goodwill. Goodwill is calculated when you gain control. For instance, if you acquire 70% of that company, then the NCI, the non-controlling interest, will be 30%. That means you owe 70% because you have control, and the remaining 30% is the non-controlling interest, the interest that you do not control. So because you have control, they always assume above 50% means that you have control. So because you have control, you have to consolidate your income statement. And that consolidation requires you to calculate goodwill. So how do we calculate this goodwill? Since you already have control of the business, you have to calculate the goodwill. So you calculate your goodwill by first knowing what your consideration transfer is. Consideration transfer. This consideration transfer can be in form of cash. It can be deferred consideration. Okay. It can be contingent. That is, if it is conditional for something happening. Say if the company that you're acquiring makes certain amount of profit, say 20% more in profit, then you're gonna have to pay additional consideration. Okay, when acquiring this company, there are different type of consideration, and these are some of it. Okay, so remember, if you tendered deferred consideration, that is the amount to be paid in the future. Okay, it is not conditional to anything at all. You have agreed to pay that money. Okay, make sure to bring this to present value. You're going to be discounting it to present value. Discount to present value at the beginning of the acquisition, right? At the beginning of the year. So by the end of the year, make sure to unwind or unwind, whichever. Unwind. That means that you have to restore back the present value. You have to add back the discounted amount, and that will go as an interest in your income statement. All right. So that is for the deferred consideration. Whatever future amount you have promised to pay, okay, as long as it is more than 12 months, it's going to be more than 12 months before you make that payment. Always remember to bring that to present value. Okay. Remember also that contingent consideration is a future payment, right? You have to also bring that to present value. Okay. So deferred consideration and contingent consideration are all future payments. You have to discount that to present value. We get that, right? So now let's make a very clear board here. So to calculate goodwill, let's say that you acquire you acquired 70% of the interest in the business, and then you paid a cash consideration transfer of 40 million. Okay, so since we acquired 70% interest in the business, the remaining percentage is 30%, and that goes to NCI, non-controlling interest. Non-controlling interest can be measured at proportionate net of assets or at fair value. For this tutorial, let's assume that the net asset is what, 44 million. Okay, is 44 million. So we take 30% of that. Let's find out what that is. 44 times 0.3, that will give you 13.2. Okay, let's find out the total consideration of payments that we've made to this company. 13.2 plus 40, that is 53.2. So moving on, we have to find out what our fair value of net asset is. So as sometimes it is not given, you have to find out what the value of net asset is. But for this tutorial, we've already assumed that our net asset is 44 million. So we're gonna less fair value of net asset 44. Okay, 44 million. So when you deduct that, what do you have as goodwill? You have 9.2 as goodwill at acquisition. Okay, so remember that this is at the beginning of the acquisition. This is the initial recognition of goodwill at acquisition. So at the reporting date, say 12 months after we've acquired this company, you always have to check for impairment. Impairment of goodwill. Okay, let's say that this goodwill has impaired by 10%. 9.2 times 0.1, it has impaired by 9.2 times 0.1, that is 0.92. Let's say that this has impaired by 10%. Okay, so what you're left with as goodwill at reporting is what? 9.2 minus 0.92 equals 8.28. This is your goodwill at reporting date. Okay, so initially when you acquire this at acquisition, okay, you recognize 9.2 as your goodwill in your non-current asset. Okay, so at the year end, if there has been any impairment, we should be tested at the end of every reporting period. If there's been any impairment, you have to deduct the impairment amount to know your current goodwill at reporting date. Okay, and this will now be your carrying amount of goodwill. Remember that goodwill cannot be reported by the selling entity. This is because it is an intangible asset. Intangible assets are not recognized by the selling entity because you need to actually sell your asset before you know what is the value. Okay, you cannot on your own evaluate the value of what your company is worth in essence. Okay, that is why the selling entity cannot report goodwill in their financial statements. Goodwill only arises when you're making a sale, and you cannot know the value of goodwill. You cannot evaluate goodwill as a selling entity. No, it is when another entity acquires your interest. they can now evaluate what is the goodwill. Okay, goodwill is a part of an intangible asset, right? So a selling entity cannot report goodwill, rather the acquiring entity, okay, reports goodwill in their financial statement because they are paying a premium to acquire a particular business. It is that premium that you're paying that constitutes goodwill, and is a means of you consolidating the excess of what you've paid, and you're recognizing that as an asset in your income statement. I hope you've understood what we've discussed here today as goodwill. Okay, so let's recap. Goodwill is what you paid in excess, so you have to put in consideration all the consideration transfer payment that you made to acquire this company, and then you compare it with what the company is actually worth. So the excess of what you of the worth of the company that you paid is called goodwill. Okay, and we have different types of consideration: cash consideration, okay, and we have deferred consideration, contingent consideration. All the future consideration, as we mentioned earlier, have to be discounted to present value at the day of acquisition. When we are initially recognizing the goodwill, we have to, discount that to present value. And then afterwards, you have to also know what is your NCI. NCI can be measured depending on the policy of the company, of the selling company. Okay, they can decide to measure their NCI at proportionate net assets or at fair value. Okay, you go ahead and deduct the net asset. Remember that net asset equals equity. So let me put that here as well. So most of the time, net asset figure might not be given. You have to go to the balance sheet to know what the net asset is. So net assets equals equity. And we know that equity constitutes share capital, retained earning, okay. Also, any revaluation that's occurred during the year is also part of the equity. Let's say you have a land that is worth initially 50, but now it is worth 60, okay. So you have 10 to add as the revaluation gain. So all of these, share capital, retained earning, and revaluation, equals what? Your net assets, because that is your equity. Okay, so from this amount here as your net asset, so knowing what your net asset is here, then you have to use that here as your net asset figure. Okay, that is if your net asset is not given as a figure. If the net asset is not given, you go to statement of financial position, your balance sheet, you get what your share capital is, what your return earning is, and based on the question you're given, if there's any revaluation gain, you add that here. Okay, all of this put together is your net asset, which equals equity. So yeah, that equity is actually what the company is worth. Okay, so we have come to the end of this tutorial. I hope it has been valuable to you. I hope you've learned one or two things here. If you have, don't hesitate to subscribe. Okay, subscribe to this channel for more tutorial like this. Okay, thank you so much. I will see you in my next video. Take care. Bye.